And now, the moment you've been waiting for all week, Courtney Smith's weekly video newsletter, TradeSmith.
How did that happen? How did we get through another year? Unbelievable. Holy moly. I just can't believe it. But hey, time flies when you're having a good time, and time flies when you're making a ton of money. So welcome to this week's market TradeSmith. I'm so excited to have you here. Happy holidays to everybody, and we're going to have a great new year. We got some really interesting things coming up here. Of course, this is the most exciting thing in this week's publication. But I've got some magic coming up here. Let's take a look here. First of all, S&P goes and makes new all-time highs, but the purple predictor does not. That's kind of a sign of the underpinnings being weak. And right now we have to even count the purple predictor as a little bit negative here for the S&P 500. Excuse me. Upper right-hand corner, we can see that the DI plus is coming down. That's the green line. That shows the buying pressure is starting to fade. And at the same time, we see the little red line there. That's the DI minus. That shows that selling pressure is starting to increase. Again, these are not signals that it's the end of the bull market, but simply that it's starting to be a little bit shaky, that we're going to be more vulnerable here over the near term. The Nasdaq, similar thing, but showing more strength. Purple predictor is just neutral over here. Seasonality, bullish, but I'm raising my get out point to about 148. That's that red line. So right now we're still on a seasonally bullish signal. That means that our positions, for me personally, I'm doubling the size of my normal positions. And of course, that means that all of our winners are double size winners. Yes, sirree, Bob. It's been a happy Christmas in the Courtney Smith household. Oh, that's right. I don't live in a house. I live in hotels. I'm homeless. All right, now let's take a look. This is from Stock Traders Almanac. I highly recommend that you subscribe to their publication, and because they do really good work like this one. Let's take a look at this. This is their prediction, or this is an outline of what could happen in the coming year. There's two lines on there. Let's look at the blue line first. The blue line is all midterm election years, going back to post-World War II. And what it says is that basically January is not a very good market. Let's do both of the lines. What the heck? They're so similar. The black one is a midterm year after a positive post-election. And that's really the scenario that applies this time around. So let's focus on the black line. But they're both very, very similar. What we should be looking at is they're saying we're going to probably have about a 2% correction in January. And I just finished showing you that some of the underpinnings of this market are starting to be a little bit shaky. So we could see a small correction here in January. Very normal, happens all the time, very common in January. But then look at what happens towards the end of January. The market just takes another 5% run up, 6% run up to the highs towards the end of April. So, and this looks totally sensible to me. Then we get a long slog. The market then just kind of slowly grinds lower. Probably see a lot of volatility into the lows in October, and then, boom, the market skyrockets. And part of the reason we get that long slog down is because of politics. Now, the midterm election is not very important for the market. And the simple reason is that almost no matter what happens, it really isn't going to affect a lot. In other words, for example, if the Democrats take over, they aren't going to get through any of their agenda because Trump will simply veto it. So the question is, and what happens usually, once again, a seasonality, is that usually the party out of power gains seats. Well, some people are saying the Democrats will gain enough to take the House. I'm not so sure that's going to happen, but they only need 2 seats to get to a 50-50 in the Senate. And even with their 48 seats now, they're being able to block a lot of appointments and a lot of legislation. So If they gain 2 seats, that would just be roughly what we have now. But if they gain 3 seats, then they would have control of the Senate as well. But once again, they're not going to get anything through. So the American people love gridlock. They love it. They complain about it bitterly, but they really do like it. They like it when we have a split Congress. So at this point, I would have to say that the odds are that the Senate turns Democratic and the House stays Republican. Now, we're 11 months off before those elections, but the American people don't like it when one party controls everything. And the first opportunity they get to throw a wrench into that, they do it. So look for a split Congress. I doubt if we'll go completely Democratic, but a split Congress. And so the next real important date for a political impact on this market is going to be the next presidential election, which is a long way off. But this chart is important because what it says is that the market hates uncertainty. And what happens is that the uncertainty of the political outline, will there be a unified Republican Congress? Or is it going to be a split Congress? Or will the Democrats take over Congress? That's going to be a negative to the market as we go through. But once it becomes clear what the outcome is going to be, and in this case, they're saying that in October we'll have a good idea of what's going to happen, then once that certainty is there, good certainty, bad certainty, it doesn't matter, just certainty, then the market will take off and have its normal fourth quarter rally. Now, I'm going to do a special webinar in a couple of weeks on the outlook for 2018. I think it's going to really surprise you. So we haven't set it up yet. I'll get it set up in the coming week and send you out an email notice. But all in all, 2018 is going to be a good year with a couple of challenging times, mainly the big boring slog in the middle of the year. But look at that fourth quarter. Woo! All right, the yield curve is going to be one of the reasons why we're going to have that slog. The yield curve is a 1 year in advance predictive indicator. So we've had it going up recently, but now it starts to go down all the way to September. Now, the yield curve doesn't tell us the direction except at extremes, and we're still actually at a high extreme, so it's still actually positive and will be until about April. And then as it slowly drags down, it won't drag the market with us, but it'll cap the market. It won't make the market be happy at all. And then combined with the normal seasonality in the summer, that's going to probably be a painful summer. But wait till you hear I have a counter argument, which I'll give in my annual update. Wow, asset allocation. This was big this week. A lot of money came into the stock market out of the bond market. This is big. Stock market RISKDICATOR slowly grinding higher, but the market still is not in a frisky mood. Global shares making new highs, but the U.S. market is really where the action is. Bonds collapsed. Oh my God, they absolutely collapsed. But I'm not looking for more collapse because the purple predictor is very bullish. But now let's take a look at this. Look at this. Every single indicator. Now remember, the green is the bond interest rate. And it obviously, if the bonds collapse, that means that bond interest rates rallied. They went up a lot. And that's because all three of our indicators went up, pushing pressure up on the bond market. All three of them. So this could keep going down. The purple predictor is saying no, but all three of our fundamental factors are saying yes, the bond market will remain under pressure. Well, if bonds remain under pressure, that means that interest rates are going to go up and the dollar should start to see some money flowing into it. And yet we really didn't. And you know me, I'm a big believer that it's not the news that's important. It's the reaction to the news. So why didn't the dollar go up when interest rates went up? And in fact, what we're doing is we're building a gigantic head and shoulders top, which would be broken here on the dollar index at 92.50. Now, let me remind you that back in August, September, October, we formed a head and shoulders bottom, which failed. I've got that purple arrow pointing to the failure. But we always have to assume that if we do break the pattern, that it will be a valid pattern. Head and shoulders patterns are known for their high reliability. Academic studies show that, and real-world trading experience shows that. So we need to watch that 92.50. If it breaks 92.50, I will go short the dollar. Now, also, if the dollar, now let's go back, if the dollar's under pressure, that would be bullish for gold. That's what's happening. But at the same time, higher interest rates is bearish for gold. But once again, what did the market pay attention to? It paid more attention to the bad dollar, or I shouldn't say bad dollar, good dollar for gold, than it paid attention to the bonds. Let's take a look at our indicators here. Up at the top, the euro, a little bit bullish. In the middle, the CRB, a little bit bullish. But down at the bottom, we see that the yen was a bit bearish. So a little bit bullish factors here. But it's a mixed bag, I guess. A little bit bullish, and gold is certainly perking up on the long side, but not enough that I want to go long because I can't figure out a way to really control my risk. And capital preservation is more important than capital appreciation. Oil into a trading range here at very, very high levels, though. I think we're going to have a hard time getting into 60. All right, everybody, all you freebies, you know what to do. You need to make a lot of money this year, so pick up your pen and write a check to us. Go online, click a few buttons. It's super easy, and it's less than a Starbucks coffee every day. So what do you want? You want a Starbucks coffee that gives you the jitters, or do you want to make money? Hey, it's a pretty simple decision. All right, freebies, love having you here. Super cool kids, hang on for just a minute, and we'll get right into the super cool part.